Welcome to part 2 of our video series all about DSCR loans. Companion video walkthroughs to our popular article series featured on BiggerPockets. This video will cover advanced strategies and provision in DSCR loans to truly get the best rate and terms on your next DSCR loan, beyond the big three, LTV, DSCR, and FICO, that played the largest role. If you missed video 1 in this series, I suggest you switch over to that one and watch that first. Let's get started with part 2. Known for easy qualifications and light documentation standards, sophisticated real estate investors are continuing to utilize DSCR loans options after maxing out on conventional financing options or simply finding it's not worth trading the time and hassle of a bank qualification for the slightly lower rates. The previous video outlined the basics of how to best position yourself as a DSCR loan borrower to get the best rates and terms on your DSCR loans. Quick recap. The rates and terms are primarily driven by three main metrics: loan-to-value, LTV ratio, debt service coverage ratio, DSCR ratio, FICO credit score. While the rate you're going to be quoted is going to be mainly driven by those three factors, there are several other pieces to the puzzle that can also change the terms offered. The savvy DSCR loan borrower will use all the options available to optimize terms, especially in a volatile rate environment like today, where every little bit of rate matters in securing profitable investments. This video will walk through the more advanced strategies real estate investors can use to minimize their rates on DSCR loans and secure the best long-term financing for their portfolios. Prepayment penalties. The best way to get the lowest rate DSCR loan is to allow the lender to place prepayment penalty provisions in the loan. Essentially, this means that for the first few years of the term, if you choose to prepay the loan early by either selling the property or refinancing, you'll have to pay a fee equal to a low percentage of the outstanding loan amount, typically something in the 1 to 5% range. If your DSCR loan continues a prepayment penalty, then your rate can generally be significantly lower, a full 100 basis points, 1% or more, depending on the structure. Why are DSCR lenders willing to give you a much better rates if there is a prepayment penalty? It's because most DSCR loans are securitized or pooled into mortgage bonds for investors, such as pension funds or insurance company, that rely on consistent and predictable cash flow, which would be jeopardized if too many loans prepay too quickly. Prepayment penalty structures options will vary from lender to lender. However, the most common are step-down structures, such as 5-4-3-2-1, which means that if prepaid during the first 12 monthly payment dates, the fee is 5%. If prepaid during the next 12 monthly payment dates, the fee is 4%, and so on, with no fees applied if the loan is prepaid anytime during the last 25 years of the 30-year term. This structure could also be shortened with penalties lowered, such as 3-2-1 or 2-1 options with the same general concept. There are additional structures that are a bit harsher, such as a fixed 5% penalty for 5 years, instead of reducing the fee percentage every year. But this structure is generally repaid handsomely by the lender with lower rates. Many lenders will be flexible around customizing these structures, but will typically limit any prepayment penalty to 5% and any penalty period to no more than 5 years. So how to take advantage of prepayment penalties as a DSCR borrower? The good news is that DSCR loans are made for investors with long-term horizons, building portfolios to hold for the long term to earn cash flow and appreciation. Thus, if you are a typical investor using DSCR loans to build a cash-flowing financial freedom portfolio, you probably aren't planning on selling properties within the 5 years window. So slapping on prepayment protection that likely won't affect you is a great lever to pull. What about refinancing if rates decrease? While a prepayment penalty may hurt if rates decreased over the first few years of your loan, and you are looking to refinance into a lower rate, the penalty amount is typically small enough so that refinancing would still be a good economic decision. According to the FHFA, since 2000, the average annual price appreciation has been 4.7%. So if rates do indeed fall, your 1 to 5% prepayment penalty will likely be more than offset by your lowered rate and potential cash-out equity from an increased value. Loan structure: fixed rates versus ARM. Another advanced option for real estate investors utilizing DSCR loans is to consider using an ARM, adjustable rate mortgage option, versus the fixed rate structure. However, It is extremely important to understand the structure and all the nuances because this can be confusing if you don't do your research. Furthermore, there is a lot of confusion and misunderstanding of the ARM option today for DSCR loans and some of the ARM structure of the early 2000s that helped facilitate the mortgage meltdown of 2008. Here are some quick things to know about ARM DSCR loans. While these are sometimes referred to as a 5-year ARM or a 7-year ARM, these are still 30-year mortgage loans. The number for an ARM typically refers to the initial part of the term where the rate is fixed rather than the full term. Unlike in the early 2000s when ARMs started floating quickly, DSCR ARMs are more of a hybrid product better described as fixed to ARM, with the fixed rate for a significant period to start the term, typically 5 or 7 years. These are typically expressed as two numbers separated by a slash, such as 5/1 or 7/6. The first numbers refers to the initial years of the term for which the rate is fixed, while the second number refers to the frequency of the rate adjustment after the fixed rate period. Note that this part is confusing. The 6 refers to floating every 6 months, while the 1 refers to floating every 1 year. Confusing or poorly structured industry standard terminology is another reason it's very important to really make sure you understand your terms and structure if you're going with the ARM DSCR loan. DSCR ARM loans are also loaded with provisions for determining the interest rate after the initial fixed rate period. The rate typically converts to a number that is equal to a predetermined margin and an index number such as secured overnight financing rate. Additionally, the floating rate is subject to a floor, typically your initial fixed rate. It can never go below a ceiling, typically your initial fixed rate, plus 5 to 6%. It can never go above, as well as periodic rate adjustment caps to prevent rate shocks or huge changes in rates in a single payment date. So how to take advantage of ARM options as a DSCR borrower? Typically, you can get a lower rate, 12.5 to 37.5 bips right now generally, with an ARM instead of a 30-year fixed rate loan, which can be worth it depending on your risk tolerance, general outlook, and personal investment plans and goals. If you are confident rates will likely be lower or stable in a 5-year time frame, most economists have this view, then it could be a smart move. Remember from the section before, prepayment penalties will not last more than 5 years, so there will be no prepayment fees associated with refinancing a DSCR loan after the initial fixed rate period. Long-term rental qualification versus short-term rentals. The biggest trend in real estate over the last few years has been investors turning to short-term rentals versus long-term rentals, primarily for the significant difference in cash flow and profitability. However, many DSCR lenders view short-term rentals as riskier and prone to disruptions in cash flow and viability due to greater dependency on the greater economy, seasonality, regulatory risk, and cost and sophistication to operate well. The current trend among DSCR lenders is to either stop lending on short-term rental properties, qualify these properties based on only how they would perform as long-term rentals, or just charge higher rates if the property is a STR. Therefore, a good strategy for an investor wanting to stick with STRs should aim to pick properties in markets that cash flow if used as a long-term or short-term rental, thus allowing the lender to generate the rate consistent with a safer long-term rental property. Note, Easy Street Capital is not like most other DSCR lenders, in that we are super friendly towards STRs. We have all of our great rates and options fully available for short-term rentals, and are the pioneer of using AirDNA to qualify and can lend on STRs in rural markets, condotels, and more. If you are a short-term rental investor, Easy Street Capital is the obvious choice. Strategic LLC and entity structures. A final advanced strategy is to strategically structure the borrowing entity to maximize credits. One of the key advantages of DSCR loans versus conventional financing is the ability to borrow through an entity such as an LLC. While there are pitfalls to avoid, investing in real estate with partner or partners that have complementary skill sets has been a tried and true recipe for big success in real estate investing. As discussed in the first video, your credit score is one of the main 3 factors for determining rates and terms. The qualifying credit score used by the DSCR lender to generate your rate can vary depending on the lender. A If there are multiple owners or if a borrowing entity, for example 50-50 owners of an LLC. Some DSCR lenders will use the lower of the two median scores, while some will use the higher. Additionally, strategic ownership structures where inexperienced or poor credit borrowers are limited to no more than 25% ownership will not have their credit pulled and won't negatively affect qualification. Note: do not cross the line between strategic entity structures and straw borrowers. Placing otherwise disinterested parties as a part of the LLC and loan guarantors just for credit qualifications is the quickest way to get your loan cancelled and potential legal troubles for mortgage fraud. Easy Street Capital is America's best DSCR lender because of our great interest rates, our flexible options for some of the stretchiest scenarios, and underwriting guidelines and qualification questions that follow in common sense. If you're interested in learning more, please review all the helpful links and tools in the caption below, and make sure to like, comment, and share this video if it's helpful.